Live from Washington, D.C., this is Transport Topics Newsmakers, the digital interview series that gives you access to candid conversations between industry experts and a veteran reporter. Sponsored by Bendix.
Hello, and thank you for tuning in to the latest edition of Newsmakers from Transport Topics. I'm Seth Clevenger, TT's Managing Editor of Features and Multimedia, and I'll be your host for the next half hour. In this program, we are very pleased to present another in-depth conversation with a leading figure in the trucking industry. Today, we're going to discuss the state of the freight market and the economic outlook for 2025 with Bob Costello, Chief Economist at American Trucking Associations. This edition of TT Newsmakers is sponsored by Bendix, a supplier of braking and active safety technologies for commercial vehicles. Before we get to our conversation with Bob, I'd like to share the following message from Bendix. And now, to learn more about current freight market conditions and the economic outlook for 2025, I'm very excited to bring in Bob Costello, Chief Economist and Senior Vice President at American Trucking Associations. Bob, it's great to have you with us here on TT Newsmakers. Thanks for joining us.
No problem, Seth. I'm glad to be here.
So it's certainly been quite a roller coaster ride for trucking companies ever since the pandemic these past several years. The initial shutdowns and disruptions that happened in 2020 gave way to really a historic boom in the freight market in 2021. But now here for the past 2.5 years, the industry's really been struggling through a freight rate recession. And really the million-dollar question that everybody's asking is, when and to what extent do you expect to see the freight market recover? So that's the top question on everybody's mind. So I'll pose that to you here right at the top. When do you expect to see that rebound?
I'm sure it is. I hear it all the time when I'm out speaking. So, Seth, I think some of the metrics that have already shown that we are climbing out of the bottom, including, data we collect on the for-hire truckload space, I think dominated by contract, not spot market necessarily, but contract. By the way, as an economist, I will tell you, whenever I look at flexion points, either up or down, I really prefer to look at sequential changes than year-over-year changes. And this is a good example of that. Sequentially, that contract truckload market overall has been coming off a bottom. Now, if you look at year-over-year changes, they're still not good comps, right? And so they're flat to down. But if we look at sequentially, there's definitely a move up. So I think in some regards, that has happened. Now, LTL, still tough. Right. That's in large part because the manufacturing base has been a little lackluster. Even surprisingly a little bit is this traditional spot market is also sort of looks like it's hit a bottom, but it hasn't started that climb up yet in terms of, and I'm really talking about all volumes here, not rates necessarily. But so I think, we're either at the bottom and some metrics are showing we are off bottom. We're still a long ways from where we were. And I think this is an important point. I don't think your audience should think, okay, because, I do think things are going to get better in 25 than they were in 24, something we haven't seen in a couple of years, as you mentioned. With that said, I am not talking about a return to a boom. I'm really talking about normal. Right. And what is normal? Well, normally truck freight volumes go up 1.5% to 2% a year. That's what I'm really talking about here, not some sort of big boom.
Yeah, not going back to 2021. That was an unusual historic moment, right? And that unfortunately is not the new normal. It won't be the new normal. Really, the current downturn in terms of rates has been driven by this oversupply of freight hauling capacity, right? Too many trucks relative to freight volumes. Uh, Unfortunately, of course, that means that to see equilibrium and see rates recover, typically that means we need more capacity to exit the market. How much more capacity do you think the industry still needs to shed to really see a recovery in freight rates?
So it's a good question. So let me just back up for a second on that. When I talk about the macroeconomy, and luckily we haven't been in this situation in the macroeconomy for decades, but there's a thing called stagflation, right? And it's where the economy is shrinking, yet inflation is high or even accelerating. And it's a terrible place for any broader economy to be. But that's exactly where we've been in trucking, right? Freight freight levels down, freight rates down, costs up. That is stagflation. It's a terrible place to be. And so it is really taken a toll. Now, with that said, we haven't, so first of all, there's no one metric I can point to and go, here you go, this shows you exactly what capacity is doing. In fact, I have to look at a lot of different things. I look at how many trucking companies are in existence at FMCSA, what is happening with revocations, what are fleets doing with their trucks, what's happening with employment of truck drivers. And if you take all of those in total, and I won't bore you with all the data, they're all generally, to different varying degrees, pointing to the same direction. And that is, capacity is in fact leaving the industry. The problem has been that we haven't, and we just talked about, how some metrics are starting to come up on the volume side, okay, but not all metrics. And really the problem has been that we haven't seen that recovery in freight demand, because if we did see a more robust recovery in it, I do think folks would be saying, oh man, definitely some capacity is left. The problem is we just haven't gotten there yet. And there's also been some other unique things about this cycle on the capacity side, right? For example, I think those really, and this is hard for me to say because it's people's livelihoods, it's their companies, it's their jobs, and so for me to say more capacity has to leave, that's a tough thing because that has a real impact on people's lives. With that said, it is a market economy, and this is things I have to look at. And so I think a couple things sustain folks longer than a normal cycle, right? First of all, those in the spot market, if they put away a lot of the money that during the boom of the pandemic, that could have sustained them for a while. Then throw in some PPP money they might have received. Mm-hmm. And, I still think that is dried up, but probably only dried up maybe this past spring, right? Or early summer. So, so there's that. The other thing I think that's happened is twofold. One is you have folks that are upside down on their trucks, right? During the boom, they were in the spot market. They went out like, it's great. And they go and they buy that really expensive used equipment back then. And they're upside down. And the lenders, even though they're not making full payments and so forth, the lenders are like, well, if my customer is upside down, I'm upside down. So what I don't want to do is take that back and then try to sell it. I'm going to sell it at a loss. So there's been that. Okay, so suppressed used truck prices has hurt in terms of clearing out sort of the supply side. And then the last thing I would say is, I've been doing this a long time, right? And longer than I like to admit often. And by the way, I won't get into it, but there's a lot of similarities to the 2001 recession, to what happened. We had an artificial boom prior to 2001, tech boom, Y2K, and then it falls off a cliff overnight. But back then, we saw a lot of trucking companies go out of business. Now, it could have been a few things. One is fuel surcharges weren't as prevalent back then as they are today, right? So full disclosure there. But I think back then, we were getting cell phones, but most of the drivers back then, when they needed, let's say they were drivers in Atlanta, they're an independent contractor, they probably went to a payphone, had a pager. Hey, I got calling up brokers. I'm in Atlanta. You got to load. And so they might sit there for a couple of days waiting to get that load. Now they just pull out this thing and they may lose and get on an app and they may lose money on those loads, but guess what? They have cash flow coming in and that also sustained them. So with the combination of all that, Seth, has really why it's been slow to leap. With that said, I'll get all the way back to what I initially said. I do think capacity is going up. If you look at tractor counts, you look at employment of drivers, you look at all this, the number of companies, it's all pointing in the same direction to varying degrees. And I think one day when we get a little bit more demand, all of a sudden people are going to be like, oh, it tightened up.
Yeah. Okay. And speaking of that demand side, we touched on it earlier, but any additional insights you could give us on some of the truck tonnage trends that we've seen this current year, and also your thoughts on again freight volumes, freight demand that we expect to see heading into next year.
Yeah, well, generally, so let's just think, because I think this is important for the viewers. So if you look at the entire truck market, about 50% of private fleets, 50% roughly is for hire. And then within the for hire, you have truckload versus LTL. So I am bullish on LTL long term. I think there's a lot of good things about LTL, but in the immediate term, it's been one of the tough spots, right? And it's because they sort of acted like the spot market, not to the extreme of the spot market back in the boom, pandemic boom, but similar to that, where they were getting a lot of excess overflow freight, and then that dropped off a cliff, and then couple in with the problems with slow, factory output's flattish, right? And so that's not helping that group. So that's been tough. And then on the full truckload side, we've already talked about spot market. It's been a little tough, but there are some bright spots, right? So on the full truckload contract side, right? So some of that is chemicals are actually decent. Okay. Some of the tank truck folks there, that production is up. You have non-residential construction activity, and you cover some of this stuff when it's infrastructure, but it's also we're building some factories, especially around semiconductors. So that's been good. That is slowing. Excuse me. Slowing the terms of the rate of the growth, but at very high levels. So that there's been some bright spots there. Things like food and so forth. I always say we may change what we eat and where we eat, but we still eat. I'm a good example of that. And so now, so it just depends on where, let's say, a refrigerated a temperature controlled carrier is in that food logistics space. But there's some bright spots there as well. Dedicated dry van was just doing great. It's starting to do a little bit better again. So I am definitely seeing some turns here in different sectors that I think are positive. But again, it's slow going. It's going to be like sort of clawing out of that hole we got into, not jumping out of it off of a springboard.
Yeah. And of course, it's a good reminder of how diverse the trucking industry is, how you're performing today and how you feel about, the year ahead, it has a lot to do with, your customers and that specific industry segment or niche that you're serving. It's not certainly the same across the board, overall.
Without a doubt. Yeah, without a doubt.
Also wanted to touch on macroeconomic conditions as well. It's kind of zooming out a little bit, beyond freight specifically. What's your forecast for the overall economy, as well as GDP growth, next year as we get ready for 2025?
So let's set a benchmark. So the benchmark is about 2%. That is what the U.S. economy should grow on average. Of course, you know what they say about averages. You stick one hand in fire, one in a bucket of ice, and on average, you're okay. But on average, we should grow about 2%. And really in the long term, Seth, just two things determine the economic growth of any economy: population growth, productivity growth. That's it. So taking those two things, we're about a 2% economy. We've been running hotter than that, right? For the last couple of years, things have been really good. So the macro economy is slowing down to the long run average, maybe a hair above that, okay, as we look into 2025. I've got most of my forecasts are going to be, 2 to 2.25% on an annualized basis per quarter. Maybe one quarter sub 2% growth. But here's the thing. Uh, roughly 70% of what's in GDP are services. We're not putting services in trailers. So what we really need to do is look at the various drivers of truck freight. That's retail. So on the retail side, the good news here is that consumers are getting back to normal levels of goods versus services. So during the pandemic, we were buying all these goods because we weren't traveling, we weren't going to sporting events, we were going to movies. And so we just started buying stuff, fixing up our homes and all this, and trucking boomed. And then the complete opposite happened later on. We bought all this stuff for our house. We bought all these things. What did we all want to do? We wanted to travel. We wanted to go to Taylor Swift concerts. We wanted to do all this sort of stuff. And while you still need truck movements associated with these experiences, it's less than when we buy a good. So what happened was we go into recession because the consumer starts traveling all over. Remember the term revenge travel, right? People were going on multiple vacations and so forth. So now that data is showing we are going back to normal levels of goods versus services. So while it's not going to boom, that is a positive. Retail inventories have actually gotten lean. I know a couple of retailers recently put out some earnings that maybe suggest something else, but a lot of them said they're pretty lean. So there is a little bit of concern about household debt for consumers. But when you look at it relative to their incomes and so forth, it's sort of we'll call it a yellow flag, not a red flag at this point, right? So something I'll watch closely. So then we can turn to manufacturing. Manufacturing's been down slightly the last 2 years, U.S. manufacturing. I actually think we can eke out about a 1% gain next year. So that's a nice little delta, right? Down 0.3, 0.4 to up maybe 1. So while it doesn't seem like a lot, that's a nice little change there, right? From down to up there. And then construction activity, I think, non-residential, as we talked about earlier, will be decent. Residential, people are going to move a little bit more. Mortgage rates have come down, although they came back up a little bit. But anyway, I do think there's some opportunities. We're going to build about 1 million new single-family homes this year and next year. So sort of flattish in that regard. So you take it all, Seth, as a whole. And, again, I think it's a little bit better. It's not going down like we've been reporting the last 2 years. It's either flattish to up, and depending on what the metric is. So, again, I think that's a positive for trucking.
Oh, good. Appreciate that overview. And another topic to get to, of course, is the election we just had in November. We'll have new leadership next year in the White House and in the Senate. So I'm curious, your vantage point, Bob, what economic and trade policies of the Trump administration 2.0 will you be watching most closely? And how might they affect the freight market in the coming years?
Yeah. So this is the unknown really that we have at this point when I'm forecasting all this stuff. So everything I've said up to this point sort of assumes nothing either too positive or too negative happens on the policy front, right? So that's a very important point. So obviously with another Trump administration, I do think we need to look at policies very closely. And again, we don't know to the extent that his administration is going to do some of this, but what are those? So the first one right out of the gate is the extension of the tax cuts that went into effect his first term. So that will be, I fully anticipate that gets done. That will absolutely be a positive. And plus there might be some other areas, right? So he's talked about not taxing tips, not taxing overtime, maybe even Social Security. I don't know how all that would work, if they would even get that done. But my point is tax policy, at least in the short term. Longer run, we have some debt issues. That is a concern, no doubt about it. But if we're talking about 25, 26 freight, that we're going to put that in the good camp. Okay, so that will be a positive. But then there's some other things you need to look out for. For example, we talked about mass deportations, right? Getting folks that are not here legally and sending them out of the country. Um, okay, but I think what we need to understand from an economic perspective is, there are estimates that up to a quarter of the people in the construction industry are undocumented. So if all of a sudden, let's just say even 10% of those folks are gone, that can slow down construction activity. And so something we need to watch for in trucking. Another one that I work on pretty extensively that the president-elect has said is tariffs. And he's talked about a 60% tariff. Remember, we've already had tariffs. He put in tariffs when he was in office. And then, while the Biden administration got rid of some of them, especially on European stuff, they kept all the 232 tariffs on China and other places. So it's not like they got rid of all of them. So it's an addition to. So he's talking about a 60% tariff on all goods from China and 10 to 20% tariffs on goods from all other countries. Sometimes this is used as a negotiating chip, like, hey, we want you to do this and we'll take away the proposed tariffs if you do that. Suffice it to say, we as an industry need to watch this closely because tariffs act as a tax on the consumer. It is paid for by U.S. companies, by ultimately consumers. So if there's a bunch of new tariffs, that could offset, maybe even completely offset any tax policies that go into effect. So we'll have to watch that closely. Related to that, you could get in a situation where then all of a sudden, and it takes a while for this to go through. So if he puts tariffs on in January, February, and you're like March, April, you're like, it hasn't had any impact. Just wait. It takes a while, just like interest rates, to go through the system. And so the same thing, all of a sudden the Federal Reserve may say, hold on, we now can't decrease interest rates anymore, is like we had planned. And in fact, the market's already sort of taking that into effect. They are not expecting as much of a drop in interest rates. So those are all things around immediately that we will be watching with the new administration. And of course, the last thing that's important to our industry is in 2026, USMCA is up for review. It's not a renegotiate. Well, it's not supposed to be a renegotiation like we went through back when President Trump was in last time. It is supposed to be a lighter sort of review of that, but we'll have to wait and see. I mean, depends on it. So anyways, long-winded way of saying, Seth, there's a lot of stuff that we have to watch. Some absolutely positive, some not positive.
Got it. Gives us a good idea of what to watch closely for as we move into the new year. Another trend, really a long-term trend that's been ongoing that we've been watching closely is the nearshoring of manufacturing, especially from China to Mexico. It's been an ongoing trend. And, for trucking, of course, this can generate more demand for cross-border freight. So it's a good thing typically for trucking, I'd say on the whole. Do you expect nearshoring to accelerate in the years ahead? Is this going to continue? And what does this mean for freight and for trucking in the years ahead?
So one of the, earlier we talked about, some bright spots, and I failed to mention cross-border with Mexico has been one of those bright spots, right? And it's because of what you're just talking about. Now, I will say the one challenge for those fleets that are doing a lot of that is the imbalance, right? That's gotten greater. So more northbound out of Mexico than southbound into Mexico. So that is a challenge for those fleets doing that. But yes, that has grown nicely. And I think we'll continue to grow. So my outlook, is positive for that, for Mexico in particular. With that said, there's a couple things that your viewers need to watch out for, right? One is, of course, the president-elect has talked about closing the border. Okay, what does that mean? I think it means Mexico needs to stop the migrants from coming to our border, okay? But he hasn't, said that in very clear terms. He has just said we are going to close the border. Again, hopefully that has nothing to do with freight, but something we're gonna watch there. So there's that. The other thing to watch out for is, and I've just recently been to Mexico. I'm getting ready to go back to Mexico. I'm telling you right now, Chinese companies are setting up shop down there, and they're setting up shop to try to avoid the
Yeah.
tariffs. So that could be a real wedge between the U.S. and Mexico. Is China is setting up operations down there? So for their companies, so something else to watch out for. So, and of course we have a new President Sheinbaum, Claudia Sheinbaum in Mexico is just got sworn in last month, a couple months, this fall, and then we'll have a new U.S. president. So some dynamics to watch for there as well. Overall, putting that stuff aside, I remain optimistic. I think there's a lot of opportunities, and not to say anything against Canada either. I think there's opportunities there as well. After all, there's a lot of supply chains that are all three countries and freight going across it, and that's, as you said earlier, that's really good for trucking because most of that freight moves via truck.
Yeah. So of course, in addition to nearshoring, there's also this this push for reshoring, right? Moving manufacturing or maybe revitalizing manufacturing in the U.S. What is you already talked about kind of the near term outlook. What's your longer term outlook, kind of big picture, further down the horizon for U.S. manufacturing? What do you see happening, not just in the immediate term, but longer, further out?
Well, for a long time, and not so much recently, but for years you heard, oh, we don't make anything in the US anymore. That couldn't be further from the truth, right? We do have a lot of manufacturing base. But the thing we have to remember is what are we good at manufacturing? We're good at manufacturing expensive, high end, like, non-labor intensive stuff, right? Because the labor intensive stuff is going to go to cheaper labor markets. Of course, to the south, Mexico, but people need to realize Mexican wages are higher than Chinese wages. So and that's also a problem. And for years we exported our inflation, and people are like, how do you export inflation? Well, we moved production to China where it's a lot cheaper to manufacture, and then we were buying those goods, and our inflation rates were lower as a result. And if we're doing more nearshoring and reshoring, okay, we have to understand inflation probably does not go back to that 2%. And we're not even talking about tariffs. With that said, yeah, I mean, we're starting to build semiconductor plants. There's a big one going up in Arizona. We've got other ones going around. So I'm bullish on U.S. manufacturing generally, but understand it is not everything. It is non-labor intensive, higher end stuff that products that we're really good at producing in the U.S.
Okay. Another topic been watching these past couple years in the current market conditions is, even though that we've seen, for hire trucking rates have been down, that's of course favorable to shippers. We continue to see prominent shippers ramp up their investments in their own private fleets. Now that's kind of anecdotal, right? You see some big examples of that, like Walmart really ramping up what they're doing, while also of course being really sending a lot of freight to the for hire market too, of course.
Right.
But this is kind of a balance between optimizing costs versus taking more control over their supply chains. Where do you see that balance moving forward for especially some of the large shippers that are also large fleet operators, and this balance between private fleets and private fleet investments versus relying more on the for hire carriers as the market changes?
Well, you're exactly right, Seth, and it's one of the reasons why the for hire market hasn't recovered as much. It's because some of these private fleets have expanded. I mean, I won't talk about any individual specific ones, but as a group, there's no doubt that there's been growth in the private fleets, something we have not seen, by the way, for a very long time, right? For years and years, private fleets, were slowing down as they were outsourcing more and more of their freight to the for hire market. I will tell you, I think it was a bit of a knee jerk reaction. I think it was a knee jerk reaction to unprecedented gains in rates during the pandemic boom. And now, not all of them, I'm sure there's some that are being successful, but I think in general, I suspect some of these private fleets are like, boy, we expanded and now I'm not so sure that was the right idea. And part of that is when you operate a private fleet and you're a big shipper, you can give your best freight to your drivers, right? And you can, and that, what does that do? That keeps turnover down, it makes hiring easy, and so forth. And all of a sudden you grow beyond that. Now you've got the exact same driver problems that the for hire fleets have.
Yep.
And of course, with rates coming down, I suspect there's a little bit of soul searching going on in this. And I'm not to say that they're going to put back everything that they grew, but I suspect some capex may be, they may be looking at that going, maybe we need to maybe that was a bit of it. And I get it. It was, forget the prices. It was just hard to get capacity and they were frustrated. Like, why don't we have our own capacity then? But that was a one-off. Well, hopefully it's a one-off, but it is a one-off event, 1 in 100 years event. Like, I think that you're going to probably see it move back the other way.
Okay, no, that's actually very, very good insights there, and thoughts on this kind of this balance that shippers have on what freight do we handle ourselves, and where do we look to the market, and that'll be interesting to watch that dynamic. Another news item, of course, that was big this fall that I wanted to touch on a little bit were the labor negotiations for dock workers at the East and Gulf Coast ports. That's unfortunately has been coming back to the forefront now. There's a mid-January deadline coming up for that. How critical could this issue become for supply chains if we do see workers strike again in a more significant way this coming year?
Oh, I think it will absolutely be significant if that in fact happens, right? And of course, you have a new administration who's been very pro-labor, especially relative to what traditional Republicans are. With that said, I think is also pro-business and is so we'll have to see what this administration might do if they would step in. I mean, clearly the Biden administration made it very clear that they were not going to step in, okay, and do this and to stop them and make them go to the negotiating table. So if in fact we get to that point, fingers crossed we do not, but if we get to a excuse me, get to a strike, it will absolutely impact the industry and it will impact trucking in that, when things come into the East Coast and Gulf Coast ports, they're more likely going on truck the entire time than say West Coast ports that will be railed to the Midwest, either Texas or Chicago, and then trucked from there. So it is something I will just another one of those things. We got policy stuff, but we also have that things you've really got to watch for as we get into the new year and see where we head. But yes, it is something that is near the top of the list of things to watch out for.
Okay. Just, here we are at the end of the current year. So I think it's appropriate to ask about, expectations for the holiday shipping season. Of course, we're past the peak for trucking, but for folks that are active in the holidays, your thoughts and expectations for this year's holiday season and what that could drive in terms of freight.
Well, you're absolutely right, and I think a lot of the holiday shipping was actually pulled forward for a host of reasons this year. Some of it was the strikes, like potential strikes in the ports and so forth. So we saw a nice little bump earlier than normal from that. So it's not going as late. I think the big thing I'm watching for more than the freight volumes here, Seth, is what are consumers doing? Okay, and you're starting to hear it from some of the retailer third quarter. Granted, it's third quarter, not fourth quarter, but third quarter earnings numbers, and that is consumers are spending. That's the positive, right? They continue to spend, but they are getting more selective, right? They are even some sort of middle to lower tier in terms of cost providers of retailers are saying we're seeing higher income people come down to we don't not normally seeing looking for bargains. So I think the consumers being more selective. and looking for deals, because while they have, I think consumer spending is going to go up nicely. Remember, and even though, and this is an important part I didn't mention in the macro stuff, inflation rates have slowed from very high levels, but generally prices have not.
Yeah.
Right. So that's one of the things, that's one of the factors that was a key point in the election, right? And I think helped Trump win, is prices remained high, even if inflation, even if guys like me talk about, oh, inflation's down, inflation's down. Yeah, but when the consumer goes to the store, the prices haven't really fallen. Now, with that said, some goods inflation has come back. It's a little bit, and prices have come down a little bit, but not across, and so, but across the board inflation. So my point is, consumers are going to spend. They're going to look for deals there, and that's going to, all this is going to help trucking. They're going to look for deals, but they're also going to be, inflation has eaten into some of the volumes that they'll be able to buy, right? So even if they spend, let's 7% more than they did last year, understand that some of that gain was inflation, and so the volume gain is less. So if you look at it, and that's why when I look at if I look at like spending, I always like to look at it in real terms. Real terms simply means I'm adjusting for inflation, because that to me gets closer to a volume metric for the trucking industry. And as a result, we're going to see, I would say, average spending by consumers this year.
Okay. Of course, we've been focusing, on next year, 2025, but always like to get to the crystal ball question. So I'll do that here. But we look out further into the future. What are some of the long-term business trends and issues that you think are going to shape the future of the trucking business?
Boy, that's a good question. I mean, I think there's a lot. I think there's, what we've learned here in the last few years is, with volumes down, rates down, costs up, a lot of companies have really tried to reduce and get more efficient and reduce their costs as much as possible. Most of that has been good in good ways. Getting more efficient and all. I do think that some of it has been a problem. I do think there's some folks that have put off maintenance spending that's going to eventually, here in the more near term, you're talking longer term, more near term, will hurt them. Some of it I could go on forever, but talk about the illegal use of B1 drivers. I think that is absolutely happening. I would fully anticipate a crackdown on that as we go into next year, especially with the Trump administration. I think that is going to be something that's going to be easy to get them involved with, and so forth. So that's Mexican drivers hauling domestic freight, not doing the international stuff back and forth. So that. But my point is things like AI, right? I think, is that going to help fleets get more efficient and do things? What happens with the driver market over the next few years? As we get, the driver market is definitely softened. It's still hard to find quality drivers. But is that going to tighten up, and what does that look like over the next few years? So these are just some things in my space. And of course, longer term, we can talk about international trade. There has been definitely, after years of expanding trade, there's been this globally, this idea of maybe not so much anymore. So those are things I'm
Okay,
watching.
I appreciate that. And speaking of sort of this shift toward AI and improved decision making and business intelligence, it is amazing how far we've come since 20 years ago or so, when we it was a driver at the payphone at the truck stop, waiting for days on end. Okay, when's the next load coming? But there's still a lot of room for improvement to make the whole system more efficient. Before I let you go, Bob, just like to open it up one last time here to any final thoughts you'd like to share with us about the economy, about the freight market as we get ready for 2025.
Yeah. So again, really watching what happens with the new administration in terms of policies, as well as the East Coast, Gulf Coast potential port strike. Putting that aside, and let's just, I think the idea is back to normal, right? So that means a little bit better volumes, a little bit better freight market, and I think that's my outlook for 2025.
Excellent. Hey, this has been a great conversation. I see we're out of time here, but really appreciate your insights and all the knowledge you can tap into for this program. And Really appreciate having you on the program and spending some time with us.
My pleasure, Seth. Thanks.
Thank you for joining us today. For more information on future episodes, visit ttnews.com. This has been Transport Topics Newsmakers.